When you first got into trading, how long did it kind of take you to really kind of grasp things? Was it like an overnight thing? You took to it pretty quickly, or?
No, not that quickly. I've still done all the same stupid stuff that you shouldn't do. You still do the stupid things and have a good month and you make a tenner or 20 quid. I'd say probably a good 18 months or so.
Use that as an example. You're long McDonald's and the technicals just aren't aligning with the fundamentals. At what point do you kind of accept invalidation of the trade?
If they're not in line, I'm going to be asking the question, why? What am I missing? Especially nowadays with the information flow, how quickly everybody gets it on their phone and stuff like that. Markets aren't perfectly efficient because obviously there's human sentiment and people are irrational. If the two aren't aligning, I'm asking the question, why and what am I missing? Rather than just kind of going, oh, the market must be wrong.
What separates average traders from the best? So even guys on the floor who are profitable, you always have, one guy who outperforms. What separates the average guys from the best in the game?
Now, my personal opinion, I think it's basically the guys that tend to do the best long term, they're normally average for most of the time. And there's also studies that have been done on this when you look at the best performing funds over like the last 10, 15, 20 years, whatever. The guys that are average all the time, they kind of just steadily compound and build over time. Their long-term track record actually becomes better. But there's also then the other side of it is that when a rare opportunity does present itself, they're not scared to be aggressive. And I think that's really a...
Welcome back to another episode of the Pursuit of Profit pod. Today I'm joined by Ben Sparham.
Yep.
Welcome.
How are we doing? You right?
Very good, thank you. You?
Yeah, very good, thank you. Very good.
Good. Thank you for coming all the way from sunny Kent.
Yeah, thanks for having me. Beautiful day, as we can see.
Yeah, not too bad. Cool. Well, I know you've been on a few podcasts. Some of my watchers, some of my viewers probably know who you are. They've seen some of your stuff online already. But if you could just give me very brief on your background, not too much. Like we said, we don't spend too much time there, but...
Yeah, no, that's cool. I'll keep it nice and brief. So basically, long story short, I'm 33 now. I've been in markets for about 12 years. Got into markets a little bit by accident. I used to do personal training and stuff like that when I was like 18, 19. Wanted to get out of it. And a client of mine worked in recruitment in the financial sector. So managed to get me a job just as an account manager, nothing fancy, basically customer service effectively, a small startup fund, only about 10 million under management. So by fund standards, obviously it's a small amount of money.
Yeah.
But that was my first kind of step into markets, if you will, because obviously then it kind of exposed me to it. Because I'm then on the trading floor, seeing what the guys are doing every day, getting to interact with them. And that kind of really kind of set things going. So I was really fortunate. A guy called Ken there was quite happy to spend quite a bit of time with me. They used to trade UK equities and FX as well, majors. So that kind of really just sort of snowballed from there. I've worked at a couple of trading floors since, and it's all kind of just kept rolling and rolling. And now the last sort of 5 years, just purely managing my own portfolio and some client money and some family money and stuff like that. So yeah, it's kind of a quick summary basically.
Yeah, perfect. All right, cool. So when you first got into trading and you started working with, was it Ken? You said the
guy that was on the desk, yeah.
How long did it kind of take you to really kind of grasp things? Was it like an overnight thing? You took to it pretty quickly, or?
No, not that quickly. I've still done all the same stupid stuff that you shouldn't do. Because obviously you're sitting there, right? You've only got 500 quid account or whatever to start with. So you still do the stupid things in that, have a good month and you make a tenner or 20 quid. You're like, I don't want to, by percentage terms, it's not too bad. But you're sitting there thinking, oh, what's the point in that sort of thing?
Yeah.
Over risky and stuff like that. Blew up some accounts when I was younger. But in terms of actually to the point where I was actually consistent, I'd say probably a good 18 months or so, because I still had to get out of the bad habits and doing the silly things. And it takes time at the end of the day. Even when you're immersed in an environment like that, it still takes time to kind of build up any kind of consistency. Market conditions that might pop up that you haven't experienced before, stuff like that. So I still say it took me a good 18 months or so before I was kind of consistent to any kind of standard anyway.
Okay. And what market was it that you first found success in? Was it FX or equities?
So I used to trade FX predominantly when I first started. And then moved more into US equities a bit later on. The opportunity set's just bigger, I find anyway. Volatility is a bit higher. I know volatility is a word that normally scares people, but it doesn't mean more risk. It just means basically a measure of movement, right?
Yeah.
So if something's not volatile, if it's not moving in any way, shape or form, you can't make money. It's not going anywhere, right? I moved over to US equities, just a bigger opportunity set. There's a lot better data as well that you can get on US markets and companies and stuff like that with the filings, and kind of just naturally progressed across from there, really.
Okay, and now you're just US equities?
Predominantly US equities. I will trade some commodities and things like that as well, or some bonds if I feel there's reason to transition. But the opportunity set, like I say, is predominantly better in US equities. It's the best performing asset class as well. So over the long term, you really want to be focused there, unless your goal of the portfolio is obviously to just kind of really narrow down on the risk and stuff like that. In that case, you're going to diversify asset classes and stuff. But depends on the goal of the portfolio, yeah.
Brilliant. And that's kind of what I want to touch on and really kind of dive into with you is portfolio, because a lot of guys watching this I heard you mention on another pod as well, they'll take a gold trade today, or they'll long cable today, or they'll be short, euro dollar, for example. But that concept of portfolio is probably quite alien to some of the guys watching this. Can you kind of explain your kind of framework for the portfolio, kind of what it means, and just kind of give them a bit of background?
Yeah, of course. So I have a couple of different portfolios that I run, but if you look at where the majority of my capital is, it's a US equities, long US equities portfolio. I will hedge and stuff like that, but predominantly most of the time it's long US equities. The overall framework is like a systematic top-down approach. So basically I'm looking at macroeconomic data, drilling down into fundamental catalysts and drivers, basically, essentially trying to work out what I think is going to move, what individual companies, what sectors, things like that, and just kind of slowly working your way down to find the best quality opportunities. From there, obviously overlaying then some technicals, nothing crazy, no secret special patterns or any kind of the stuff you see on YouTube or whatever. It's very, very simple. I'm basically looking to identify momentum. It's as simple as that, right? I think stock A is going to go up because of X, Y, Z. Well, now I need to see if the market agrees with me, because just because I've got a thesis over here doesn't mean I'm going to make money on it. The market also needs to move in order for me to make money. So I might have an idea and something stays on the watch list because the market isn't agreeing with me for now, or there starts to be some momentum kicks in, some buyers come in, start to form a nice trend, etc., some breakouts, whatever it might be, and then obviously looking to hop in on that momentum, basically. So it kind of works from top to bottom in that process.
Yeah, makes sense. It's funny. I was talking to the guys off camera about TA, because I did a video of Brent Donnelly a while ago, and I asked him what TA does he use, and he was like, I use horizontal levels, and I was kind of there like, what else? He was like, yeah, that's it. He was like, I do.
It's nothing fancy.
Yeah, the trade ideas created before, the technical is only a very small part of it.
Yeah.
Whereas a lot of guys in the retail niche, don't get me wrong, there's obviously great technical traders and great technicians who just look at that. But a lot of retail guys are just fully focused on technicals without any kind of like higher time frame macro view.
Yeah.
So yeah, in terms of technicals, what is it you kind of look for?
Very, very simple. Again, like it's from a visual aspect, I quite like having some moving averages on there simply to give a visual confirmation of momentum. So I'm not going to sit there using 50, 20, 100 moving averages. I use them for relevant time frames. So it'd be 20 days, 60 days, that's obviously quarterly, 20 days in a month, right? Yeah. So your 60 days normally your quarterly, 252 is normally yearly. That's the average number of business days in a year. You're basically getting an idea on where the momentum is over set timeframes and getting an idea of whether we've shifted momentum, are we still in the same kind of trend, stuff like that. And then from there, it's very basic structure, highs and lows. Are we getting breakouts? Are we forming a new higher lows, stuff like that, looking for trends? Really nothing overly complicated. Like it's the sort of stuff that, when you first started learning to trade, then basic technical analysis tools that you would look at basically doesn't really go any further than that.
Yeah.
What people tend to do is happens a lot with people trying to sell courses and stuff online. They're kind of repackaging the same stuff from over here, but they've got to make it sound sexy and new, right? And make it sound different to what this guy's selling. So they put a new label on it. They kind of add something to make it look more complicated, throw an indicator on the top, and then they give it a new name or a new model or whatever, because now it's easy to sell, but it's not really how it works. Like if we walk over the road there and start putting some of the stuff that you see people talking about online and ask them traders over there, they would literally laugh at you.
Yeah.
Like they're not going to be using that on the trading floors over there. So it's very, very simplistic. It's really not anything complicated, to be honest with you.
Yeah. Is it more just kind of like a risk management tool? Just so like for you, I guess the fundamentals tell you what to buy, technicals kind of say when to get in, where your invalidation would be and that kind of thing?
Yeah, pretty much. I'd say 80 to 90% of the work is fundamental macro work, most of it being fundamental. Like the macros that we use is, we can go into it more a little bit later on, but you're looking at the correlation between the economy and the overall index and the overall stock market, right? The correlation is very high. A lot of people kind of forget that. They kind of get very wrapped up in just what individual stocks are doing, but there is a correlation there. So that gives an idea basically on how aggressive or defensive I want the portfolio to be structured. Do I want to have a hedge? Do I want to diversify asset classes, things like that? And then from there, I can lay into the fundamentals, which gives me an idea of what I actually now want to buy based on that kind of framework. And then the technicals are literally a confirmation tool, like I say. Have we got momentum now, within that stock that I want to buy? Is the momentum shifting? So like you said, from a risk management aspect, right, position management aspect, if I've been riding something for the last couple of months, momentum starts to shift. Is there a reason for that? Are the fundamentals, changing at all, anything like this? And maybe it's time to now cut the position and bank profits and kind of move on because the momentum's being run out. So it's very simplistic in kind of where it's being used, but people just seem to focus on this one little part over here, which in reality is probably only about 10% of a normal process, if that makes sense.
Okay, that makes sense. And in terms of position management, if you've got, I don't know, you buy McDonald's, for example, it runs this, one of the fastest horses. How do you kind of rebalance? Do you do like quarterly rebalances or?
Yeah, so It's normally done on how much the position has moved. So if we just make it really easy, right? Imagine you've got 10 stocks in a portfolio, 9 of them are dead flat, 1 of them's up 50%. Well, the actual true value of that now in your portfolio from a weighting aspect is obviously massively increased. So you'd be rebalancing at a point like that. But I wouldn't rebalance just for the sake of rebalancing, because of course you are then executing more positions. So there's a commission you're paying, spreads, things like that. That can obviously now start to eat into your actual returns, basically. So it's normally if something's massively run and it's now massively outweighing, because I normally run an equal weighted portfolio when I'm running stocks only anyway. It'd be an equal weighted portfolio. So again, if we've got 10 and they're all 10% of the portfolio, if something's now massively run and it's now the equivalent of 18% in the portfolio, well, that's now obviously 80% more than what it should be in terms of the weighting. So at that point, we'll typically look to then trim it down, add to some other positions. It might be a case of, if it's got extended and I now don't think the idea is good up here, I might obviously cut the position altogether.
Yeah.
But it's all about creating that healthy balance, basically.
Okay, cool. And in terms of timeframes for your TA, what timeframes do you look at? Because a lot of guys now, under 1 minute, kind of use a
30-second charts.
30-second charts, yeah. But a lot of the best traders I know, it's like mainly daily time frame, 4 hour, weekly, monthly.
Daily's as low as I'll go.
Yeah.
So it's predominantly monthly, weekly, daily. And I'm looking for the overlay of those things. So I'm looking for the general overall monthly trend, things like that, how that aligns with, if we're looking at stocks, how that aligns with obviously earnings per share growth, cash flow growth, things like that. Looking at that overlay and obviously how they line up. Drilling down into the weekly, that can give you an idea if there's any shifts essentially in the momentum. Because if you've got a monthly that's on a downtrend, for example, if we keep things really simple, monthly's on a downtrend, there might be signs on the daily or the weekly that you're going to get that rotation first, or you might get like a daily base and a breakout or something like that. So you're looking for that rotation. Obviously, if you're already trending up on all three, then it doesn't really make any difference. And it works the other way as well. If you're potentially cutting a position, potentially coming out of a position, same sort of thing there. If you've got something that's really extending and running out to the upside, well, you might get idea or potential insight into a rotation, to the downside now, and you might actually want to now cut out that position rather than waiting for the monthly to rotate. So, monthly, weekly, daily, I'll be keeping an eye on and kind of using them in tandem with each other, basically.
Okay. And say you've got a position, fundamentally it's sound. You're long, for example, again, McDonald's, for example. So use that as an example. You're long McDonald's and the technicals just aren't aligning with the fundamentals. At what point do you kind of accept invalidation of the trade?
So really and truly, I always want them to line up, right? So if they're not in line, I'm going to be asking the question, why? What am I missing? Because especially nowadays with the information flow, how quickly everybody gets it on their phone and stuff like that, markets aren't perfectly efficient because obviously there's human sentiment and people are irrational. But most of the time, you'll typically find that they're in a region of being reasonably priced. Valuations might be different, but that could be obviously a reason for that higher growth and stuff like this, right? So if the two aren't aligning, I'm asking the question, why and what am I missing, rather than just kind of going, oh, the market must be wrong. There's probably something that I'm missing, right? So that's when I start to expand a little bit more, do some fundamental digging, going into the 10Ks, things like that. Most of the time is going to be spent on that side of things. And it's funny because when you speak to people and you kind of talk about doing all this side of things, they think that you're spending so much time sitting there like reading earnings reports and all this kind of stuff. I probably spend less time per week than what most of these other guys are doing in terms of when they're staring at charts all day. Because they're sitting there just staring at charts for 10 hours a day. I probably do 30 minutes, 45 minutes, hour tops per day if you was to kind of average it out. So I'm really spending a lot less time. It just sounds like there's a lot of work going on. But you're just kind of keeping your finger on the pulse of the story, right? You've got the numbers and the data, but then there's always something that's then driving the stock and the story behind it. So you kind of align those two things. And if it's not aligning, the market's telling you it's not, then it's my job to find out why. And if it's just simply a case of it's not aligning at the moment and there is just a bit of a mispricing, well, I can't now be stubborn and say, well, I think I'm right, so I'm just still going to be holding this or still going to be executing now. Because again, like we said earlier on, you're only going to make money when the market agrees with you. So I've now got to wait for that market sentiment to shift, wait for the participants to basically agree with what my view is, and then I can actually now look to hop in.
Yeah, I guess with the fundamentals as well, it's not changing day to day, right? Earnings only comes out every few months. There's not a ton of data all the time that you need to take in.
No, you've got quarterly earnings for a start, things like that. The leading macro data that I look at, things like ISM services, ISM manufacturing, they're released once a month. So if you're updating your data sets, you're literally looking at like 5-10 minutes a month to update that one piece of data or something. So it's not a case of you have to constantly sit there. And it also, makes life a lot easier because the fundamentals are a lot slower to change. You don't need to constantly be sitting there looking at things and what's going on and what's the market doing and stuff like that, because it's not going to have changed overnight.
Yeah.
The sentiment might quickly change if some piece of news comes out and you get a quick reaction to it, but the underlying fundamentals are still the same. So unless they've massively changed, which, like you say, probably not going to happen over a short period of time, you can just let the positions continue to run and just manage it as you see fit. At the end of the day, it all ties in with the risk that you're happy to take. And if you feel like the risk is increasing in that position at the moment for whatever reason, then you can look to see, does that match your original thesis that you had when you actually executed to start with?
Yeah, makes sense. So for a lot of guys watching this, fundamental analysis to them is probably looking at the economic calendar, right?
Yeah. Red folder news.
Yeah,
about as far as it goes.
Yeah. So for the FX guys out there and, guys who want to trade equities, where would you recommend they start? What kind of basic framework can you kind of provide them or?
On the fundamental side of things, keep it really simple. You just got to get to know the business, right? I think people tend to overcomplicate it, but you've got to get to know the business, get to know the story of the company behind the numbers. So we think of it really easy. Apple are expected to grow their earnings at 10% this year. Well, why is that? Find out, right? Just pull up some information on, use Yahoo Finance, Seeking Alpha, whatever, get to know the company. Why are they projecting that? What are the management saying? Are they expecting iPhone sales to jump up in China, for example? Or, find out what's going on. You just got to get to know. I think people seem to forget this, is that you might only be buying one share of a company that has 1 billion shares outstanding, but you're still part owner of a business effectively. So if your part ownership is going to increase in value, that business has to be growing relative compared to where it is at the moment, right? Yeah. So you've got to find out, why would that business grow from where we are today? Basically what you're doing. So you'll find out what the company does, why it could be growing. Does it have a solid balance sheet? Has it got tons of debt? Has it got loads of cash? What's the situation with it? Just get to know the business, basically. And if it's a business that you understand, it's a lot easier now for you to make a judgment on how likely that is to continue growing and things like that going forward. If you don't understand the company, if it's a high-tech company and you're sitting there reading about it and you think, what does that mean? Like, just leave it. There's like 10,000 stocks out there. You don't have to be an expert in all of them. It's that whole Warren Buffett thing of keeping it in your circle of competence, right? You don't understand what the company does, even when you've done a bit of digging, just move on. Put it to the side and move on to something else. There's plenty of opportunities out there. You don't have to chase them all.
Absolutely. Makes sense. And for your positions, do you look at kind of like individual risk to reward, or is it more just open position, this is my invalidation, and rebalance as it goes?
Yeah, so I don't personally use leverage. So my risk management comes down to position sizing. Right. Okay. Because if I've put £1,000 in Google stock, well, Google stock has to go to zero for me to lose £1,000.
Yeah.
Right. So if you've actually invested in high quality companies and stuff like that aren't obviously going to go to zero, not some penny stock junk that could suddenly vanish overnight.
Yeah.
Well, then obviously it's very easy to kind of start managing your risk at this point. So that's generally how it's being done. And obviously, as we spoke about earlier on, if a company's really run up and stuff like that, you might look to trim some profits. And I will always hold a position all the time that the idea is still valid. So if I buy a stock today, stock A, I buy that today. If it's still running nicely in 6 months' time, why would I get rid of it?
Yeah.
It's making me money. It doesn't make any sense to get rid of it just to buy something else for the sake of it.
Yeah.
Got a good trade, running nicely. If I held on to it for the next 3 years, but if it's constantly making me money every year, why do I have to find something else? The whole idea is to make money, right? So I want to find the best quality opportunities and hold them all the time. That continues to be the case. If the thesis changes at some point, then I'll get rid of it and then I'll look to rotate into something else. But if the idea is making me money, it's growing, it's appreciating, it might be a dividend in place, whatever it is, why would I get rid of it? Doesn't make any sense. The only other time that it might be a case of is if the stock massively ramps up on something. Good example of that was I held Chipotle stock last year. Only held it for about a month because it basically massively ramped up and was then trading at like 50 something times earnings, which based on what I'd looked at, looked well ahead of itself basically. So I just took my profits and said, thank you very much. I made about 30% on it in a month.
Yeah.
I was like, okay, there's no point me holding that now, because at that point, the risk is now higher to hold it at these prices relative to something else I can roll into. So there's actually a better opportunity elsewhere. Whereas if it was still trading at, say, 25, 30 times earnings or whatever, and just slowly cranking up over time and slowly making me money, but I just let it ride. But at that point, the risk had increased because it got overstretched and overvalued. So it was better for me to now rotate into something else. So you're always kind of playing that balancing act between the quality of ideas, basically, if that makes sense.
Yeah, no, it does. So you're not really using linear targets. It's just open, and then if things get overheated, then you might rotate. Like
Exactly
you said,
that.
Chipotle, for example.
Exactly that. So managing the risk, managing your exposure, because I think people forget that if you're up massively on one of your positions, your exposure to that position has become bigger.
Yeah.
I talk about this with people with crypto, right? Because crypto has the potential to really ramp up at times, like it has done recently at the time of filming this.
Yeah.
Well, that's all well and good, but now it's becoming a bigger weighting in your portfolio. Now, what you've got to ask yourself is something that has that volatility. Are you happy with that weighting? Now, some people will be, and that's fine. But if you're not, you now need to rebalance that, take a bit of profit off the table, kind of make sure you're keeping up with that volatility. And it's the same when you have different asset classes in your portfolio. You're weighting based on the volatility of those asset classes. So stocks are a lot more volatile than bonds, for example. So if you held 50% of each, it's not actually 50% of each, because one's going to move a lot more.
Yeah.
So you're kind of always playing this balancing act, which to somebody that's new, that might sound a little bit complicated, but once you start to get the hang of it and you kind of get into practice, it's actually pretty simplistic.
Yeah, I guess the easiest way for maybe the FX guys to understand that is if you use 5 lots on EU and 5 lots on gold. Gold's obviously a lot more volatile.
There we go.
Right?
Perfect example. It's more volatile, so therefore the risk that has to your portfolio is going to be much greater because of that volatility.
Makes sense. And for the portfolio, do you look to always be fully invested, or will you ever hold a cash position at some point?
It's very, very rare that I'll ever be in cash. So if I want to reduce risk at all, let's say, for example, at the very beginning of this year, there was a lot of uncertainty from the macro backdrop. We wasn't quite in earnings season yet, so we didn't know how the companies were going to perform and stuff like that. I didn't want to be 100% long. Now, rather than rotating into a bit of cash, I put a hedge on in the portfolio. So basically, I'm short the S&P 500. Now, the idea behind that is that I'm now not 100% long, because if now the market does fall and my individual stocks fall, I make money on my short, so it offsets some of the loss that I've had on the long side. If I'm wrong, if I am right on my longs and they continue to move higher, the loss that I have on that short position on the index is very small relative to the long position. So I can still make money in an upwards market, but I'm reducing my exposure.
Yeah.
Going to cash doesn't really have any value because it's just constantly deteriorating with inflation, all that kind of stuff. So what's the point? I might as well have it to work somewhere else, basically.
Yeah, makes sense. All right, cool. And you spoke about how much time you spend on the charts, not really, too much. A lot of guys who get into trading, especially, they kind of have this dream of going full time. They want to be a full time trader where they can, spend all day in front of the charts or go out for lunch every day, or whatever it may be. What does your kind of routine look like on a day to day?
Pretty boring, to be honest with you. So if you're looking at my general day to day, I tend to get up, go to the gym in the morning, stuff like that, get my head nice and clear. And then it's a case of I'm normally spending time looking at spreadsheets. Excel is used like anything. Looking at a lot of spreadsheets, looking at, if there's anything important coming up that week in terms of macroeconomic data. How do I want to track that? How do I want to keep on top of it? If there's anything relevant for that company that's coming out, it might not just be earnings, but there might be some sort of conference that they're delivering out, or I don't know, it could be anything, but anything that's relevant for that company over that week. And then you're just basically keeping your finger on the pulse of the markets, constantly keeping the watch list nice and hot, making sure you're on top of those opportunities. Although you don't have a position, there's a bunch of stocks that you're looking at as potential for new opportunities. You obviously want to keep on top of them, because if you decide to rotate at any point, you need to have something to rotate into, and you can't now be just kind of making a rash decision and kind of jumping into something. So it's more keeping on top of things. And I think this is probably part of the issue with Instagram and things like that. People kind of get caught up in this lifestyle thing. They think this trader's lifestyle is fucking flying to Dubai every other week and stuff like this, right? And you can do all these lovely things, but the majority of the time it's pretty boring. So this is normally why you're doing something else, or like I do some mentoring on the side and things like that. It keeps me sharp and it keeps me on top of things. But reality is, you're not sitting there just trading all the time, making a bunch of money, then going to nice lunches. It's a pretty boring thing. So you always want to be wary of those people that kind of just show these highlights all the time, because it's staged, basically. It's not real.
Yeah, and I think there's only so many lunches you can go to right before it gets boring. And then you're like,
steak's a steak, right?
Yeah, steak's a steak. One thing you touched on was spreadsheets. I'm guessing you do a lot of back testing, right?
Not so much back testing, but collating information like macroeconomic data, stuff like that. Keeping on top of these sorts of things, because a lot of it is basically trends, right? So trends in macroeconomic data, trends in fundamentals, technical trends. It's basically all trends. So you're looking at any kind of shifts in macro data, stuff like that. So I will collect all this into spreadsheets to kind of monitor trends over time within data sets. So it's not so much back testing, say what euro dollar's done over this time period. It's more keeping on top of the information that I track and looking at, okay, ISM services done this month. How does that compare to last month and the 6 months before it, etc.? Is there an obvious shift, a trend here? Are we expanding? Are we contracting? What's going on? And it allows me to kind of collect all that information and kind of keep it in one place nice and easily, basically.
Okay, that makes sense. And for the macroeconomic data, sometimes, data will come out and, people see, okay, it's higher than expectation or lower than expectation, but price will do the opposite of what the data will do. And that's, because what's priced in is maybe more aggressive or more defensive than what actually came out. How do you kind of view that? And what kind of weight do you put on how price moves after data? Will you put more weight on price or will you put more weight on the data?
So individual news releases, I don't pay attention to in terms of their importance. It's more a case of how things stack up. So if we use an example here, ISM manufacturing typically leads GDP in America, right? So it's looked at as a leading indicator. Anything above 50 is normally seen as expansive or positive, basically. Anything below 50 is seen as negative or contracting. Now, if a number comes out and let's say it's released this month and it's 48, well, based on that number alone, that's negative, right? It's below 50. But if the month before it was 46, the month before it was 45, the month before it was 42, well, we've clearly troughed in that data and now starting to expand. Markets are forward looking. So although that number might be negative, it's within a positive trend, and markets are probably now expecting now to go into expansive territory. So it's going to be looked at as bullish.
Yeah.
So it's that individual number on its own doesn't really tell the story. You've got to look at it relative to an overall data set. And so that's why it's important to collect the information as a whole rather than just some red folder news today. This is what came out. Market went up. Like it doesn't really have any relevance. Hence the reason that markets will normally kind of spike around and pretty much end up where they started an hour before. It's very rare that something comes out, as we know. Let's say it beats expectations. Market now just moves up from there and doesn't revisit. It normally has had some sort of wacky move to it, and that's because as people reacting to the news, reality is it doesn't actually make any difference on its own. So therefore, markets kind of end up back where they started, and it doesn't really make any difference.
Just the HFTs a lot of the time just going
it's
crazy.
A lot of it's almost like a liquidity event, right? There's lots of people all of a sudden jumping in and out, and so they have all of this action goes on, and then it just kind of ends up back where it was. So on its own, it doesn't really mean anything. But the retail traders tend to just focus on that one piece of data, and that's why they normally get caught out of it a lot.
Okay, makes sense. That's good. So for retail guys watching this, a pretty broad question, but what do you think is the biggest pitfall in the retail niche? So guys watching this that, they want to be a full-time trader, they're strategy hopping, they can't make it work for them. What is the one thing you think people should focus on, or like the route they should take? Is it the prop route? Is it, funding their personal account? What kind of broad advice would you give to
in terms of accounts, for example, I think you should always have your own personal money, always have your own personal accounts. We've seen it in months gone by, how quickly these online prop firms and that can disappear. Because at the bottom line is they're not there to help you make money. The way that the online props are set up, I don't even like calling them props because they're not really proprietary trading
funding companies.
They're funding companies,
evaluation firms.
A real prop firm, as a lot of people will know, but in case anybody doesn't know, would be like me and you have got 50 million quid and we want to set up our own private trading floor. We hire traders to manage our money for us and we'll allocate capital and all the rest of it. These online companies are just sitting there selling a challenge. All their revenue is generated from the challenge sales. They then give people demo accounts and they're paying people out of their own pocket. Now, in order for their very business to survive, they need more people losing than winning. So they don't want you to win. Hence the reason you see things, payout denials and people getting challenge accounts taken off of them and all sorts of things going on. Plus, there is obviously the potential issue of liquidity because they're putting no real money in the market. As I said, they're paying you out of their own pocket. So there's a period of time where sales are low for the challenges, or for some reason the bankroll's got low because the CEO is a bit of an idiot and he's never run a business in his life and he's just set it up because it's nice and easy to white label at 23 years old, for example. And, he's now spent it all on Lamborghinis and weekends in Dubai, right? Somebody now needs a big payout. Somebody now needs a big payout and they can't basically facilitate that. Well, that's when you now start to see these problems. So I would say always have your own personal capital. If you want to use and leverage these prop firms, then by all means do that. But remember what they are. They are just an online little funding company. That's not a career path for you. And ultimately, they're going to do what they can to take it off of you at some point to basically stop having to pay out. I know somebody that's quite successful with prop firms, but he'll only ever do small withdrawals. He doesn't want it to be flagging up that he's taking 50 grand out here or 40 grand out there. We'll do a couple of grand. To basically fly under the radar. So he's not becoming a problem client. So kind of use them for what they are if you're going to use them. But then I would say, look, before you start getting into any of that, you need to focus on your education. And if you don't have the right framework in place, can look at all the technical charts you want. You can be the best risk manager in the world. But if your idea generation's crap, you're not going to make any money. You're looking at the wrong things to start with. So you've got to have a proper framework. You've got to actually have a process in place and a strategy in place. And it's not just in terms of when this happens, I buy, when this happens, I sell. It's not just like staring at chart strategy. It's understanding what's moving markets, what the catalysts are for that particular asset class that you trade. Because what moves currencies could be different to what moves stocks, to what moves bonds, to what moves commodities. So understand what moves that particular market, what moves that asset class, build up a framework around that, and now have something that's actually systematic that you can constantly repeat so you have a proven edge. Now you can overlay risk management. Now you can overlay all that kind of stuff over the top and apply it to your own accounts, prop accounts, wherever you want to do it. But without that process at the beginning, all of the rest of it is completely useless to you, basically.
Yeah, absolutely. And I think going back to what you said earlier, always have your personal capital. I started learning in 2014. Funding companies weren't a thing. So I had to focus on the kind of personal capital, made some money in crypto in 2017, used that. But now, like you said, guys are very heavily focused on prop firms, and I think they're a great tool, but it's kind of created this weird dynamic in the industry where you've spoken about before as well, where you're going to have to make 8 to 10% a month. Otherwise, you don't know what you're doing, right?
Yeah, and nobody does that.
Yeah, nobody. we all know that that's not, consistent. You're not going to do that every month. No. You might have a month where you do 10%, or something will be an outlier.
Of course there will. Like for example, like I said earlier on, I don't use leverage. Yet in January of last year, I made 8.5% because it was really good market conditions.
Yeah,
I'm not going to obviously average that, right? The way you could easily think about it in terms of bringing it back to reality, the S&P 500 on average historically does 9.5% per year. It's the best performing asset class in the world, and 90% of people underperform it. Now, if it makes 9.5% a year and most people underperform, the fuck do you suddenly think you're going to make 10% a month? Right? It's just insane. Let's focus on beating the S&P over 12 months first before you start putting silly targets on top. But again, it's one of those things where prop companies put that in place because they know it's a bit like a casino, right? Yeah. A casino is going to encourage you to stay as long as possible and to play as much as possible because I know odds are the longer you play the game, you're gonna lose because they have an edge. Yeah. That's why somebody will win big in Vegas and they'll go and give you a free night in the hotel and give you drinks and dinner and all the rest of it. Because if you go and play tomorrow, they know that odds are you're going to give it all back.
Yeah.
It's the same thing with these prop companies. They know that if they set certain targets and do certain things to encourage you to be more active, the more active you are, the more likely you are to lose. Yeah. And the more likely you are to fail. So they set these big challenges because people are now chasing. They might be a good enough trader to average 1% a month, right? So compounded, they would make about 14% a year, which would be very solid returns. And if you've done that consistently over your career, you're going to make a lot of money, right? But that trader that now makes 1 or 2% a year is now giving that up to try and chase 8 or 10%. And that's when obviously things are going to go wrong because that's not realistic to do all the time, as you said. Now, it is obviously quite good that a lot of these companies took time limits away because that obviously allows you to now try and do it over time. But they also know the game. They know that people aren't going to want to wait 6 months. They know that people are still going to want to get that funded account in a month. So they know even without those time limits, most people are still going to go and blow themselves up because they don't want to build it up over 6 months. They want to get it now. They still go and do the same stupid stuff as if they didn't have the time limit in place. It's just another way of them being able to sell and say, look, we're trying to help you out. There's no time limits here. Take as long as you need.
Yeah.
Because they know you're not going to.
Yeah,
right?
Yeah.
So they're just basically waiting for you to just blow yourself up. So as we said, focus on your own money, building that capital up, because that's always your fallback. You can go anywhere in the world with it. You can trade it as much or as little as you want. Nobody can tell you what to do with it. Nobody can take it away from you. If you've got £500,000, million quid, whatever you're sitting there personally trading, nobody can do anything with that.
Yeah.
So, to you. Whereas if you've got £1 million in funding, you lose like 5% in that month, whatever, it's gone.
Yeah.
So
you can vanish overnight.
Yeah, you don't have it. Or that prop firm suddenly shuts down.
Yeah.
Or regulations suddenly change tomorrow from the FCA. It's all over.
Yeah.
Right? So it's a case if you've got to always have that there as your foundation.
Yeah, makes sense. Also, I think as well, it's again create this weird dynamic where you don't actually need to be profitable to make money with prop firms. You can take 5 challenges, fail 4, but if you pass 1 and make 10% on 1, you get a 10 grand payout. You're actually net up. But on a live account, you'd be down 40%. Yeah. So it's definitely created this weird dynamic. But I think they're a great tool to make money. But like you say, fund your personal account and start building it up from there. But yeah, I think that's where a lot of guys go wrong. Trading psychology. What are your thoughts on it? Because a lot of guys say, "Oh, my psychology is wrong," but
it obviously plays a key part, right? Because if you're doing everything right that you're supposed to do within your trading process and you get in your own way, of course that then causes you a problem.
Yeah.
But then there is obviously the other side of it is you could be a Zen-like guru trader still not going to make any money if
Yeah.
you don't know how to trade. So I think a lot of people, it might be the online gurus and stuff like that, they've kind of pushed it a little bit to make it sound like this is the reason why you're losing money. So do you know that course I sold you, Joe? I know you haven't made any money with it, but probably because your psychology, rather than blaming the stuff that they've actually given you, right?
Yeah.
So they kind of have this thing about them, and that's how they kind of go about it. And I think people then suddenly think that because they've read Trading in the Zone 5 times, they're going to suddenly go and make money. It's like, no, you still can't trade. So what difference does it make, right? So it plays its part, but you've also got to get the other side of it down. And I think I would personally, the way that I look at it is focus on the process first. Once you know you've actually got a proven system that can actually go and make money, well, then if you are finding that, from your journaling and stuff like that, that it is normally you that's actually getting in your own way, you're not following your system, well, now you obviously then need to work on that, of course. But I think people put too much weight on it. Like when they sit there going, oh, it's 90% psychology. They're talking bullshit. It's not 90% psychology. It's predominantly your trading approach. And then psychology obviously plays a role depending on the individual, because not everyone's going to need to work on it. I'm somebody, for example, that I'm quite happy taking risks and stuff like that, right? So having money on the table or losing a bit of money here and stuff, it doesn't really bother me.
Yeah.
It's that, if I make 10 grand or lose 10 grand, kind of the same in that sense, because it's part of an overall bigger process, right?
Mhm.
So losing money's never bothered me, but for some people that really would.
Yeah.
So obviously it depends on the individual how much they'll need to work on it, but just keep in mind it's only one part of the process, basically.
Makes sense. Another thing as well, as you mentioned earlier, you worked on floors, you've worked with some pretty big names in the space. What separates average traders from the best? So even guys on the floor who are profitable, you always have one guy who outperform year on year. What separates the average guys from the best in the game?
My personal opinion, I think it's basically the guys that tend to do the best long term, they're normally average for most of the time. So, and there's all sorts of studies that have been done on this when you look at the best performing funds over like the last 10, 15, 20 years, whatever. Most of the time they're average, because normally the people that have big periods of performance, they're normally risking too much all of the time, so then they have bigger drawdowns.
Mm-hmm.
The guys that are average all the time, they kind of just steadily compound and build over time. Their long-term track record actually becomes better. But there's also then the other side of it is that when a rare opportunity does present itself, they're not scared to be aggressive. And I think that's really a big key difference in that, if you're being a very sensible trader most of the time, let's use COVID as an example.
Yeah.
You're sitting there, you're managing your portfolio, etc. Blah, blah, blah. Market drops 36.5%. The S&P dropped from peak to trough when you had COVID kicked off in like March and April of 2020. Now, the guys that were aggressive during that time and didn't panic and sell everything, they then made the most money over the next couple of years after that. But if you hadn't been willing to be a bit ballsy, basically, and be aggressive at that moment in time, then obviously you wouldn't have made the money afterwards. So you've always got to be willing that when a rare opportunity like that does present itself, to be aggressive enough at that moment in time. But it's playing that balancing act between sort of aggression and defense, basically, right? Because if you're aggressive all the time, you're going to cause yourself a problem, and you're going to probably, if not blow up, have a massive drawdown at some point. You can't always be aggressive, because the markets aren't always going to give you the opportunity to be aggressive. You've got to kind of just slowly sort of plod along and sort of play the patience game. And then when the opportunity is there to be aggressive, we'll then take it. But if you're aggressive all the time, you're going to blow yourself up. So just be slow and steady, and then just be willing to act. That's normally the difference. The guys that are willing to be aggressive when it does present itself, they're the ones that then make a lot of money, basically.
Yeah, I think that's great advice. And as you know, I played a bit of crypto here and there. And what I find where a lot of crypto traders go wrong is where Bitcoin's very cyclical. Before Bitcoin breaks the all-time high, they won't be as aggressive. They wait for it to break the all-time high, wait for it to get more frothy, and they think, hold on a minute, I haven't made enough money. Then they get aggressive, take a bunch of leverage. Whereas actually, when you first see the opportunity, that's when you want to be more aggressive. Then get less aggressive as things get frothy, right?
Yeah, exactly. It's a prime example of it. Markets are the same no matter what the asset class, and that's a perfect example, yeah.
Yeah. So with your portfolio earlier, you mentioned you kind of run it equally weighted. What would you need to see to say, actually, no, I'm going to double down on this position and this could be the home run?
It's not so much that I would sort of randomly decide to do that on an individual position per se, but it might be more. It's normally more if there's a unique scenario in the market. So again, if we just kind of use COVID happens, markets drop. Most stocks are down anywhere between 30 and 50%, etc. But then you'll look at a lot of companies. So let's say Google, for example, they're still the same company.
Yeah.
But the difference is you can buy it today for 40% less than what you could have paid for it 2 months ago. So now you've basically got something on sale. It's a big discount. Had it recently with Meta, right? Meta was down about 75% from peak to trough. When you had I think it was the late part of 2021, there was some negative sentiment, and you had the bear market in 2022, so it drove prices massively down. Meta is still the same company, right? They was investing into certain things, and obviously people were kind of all negative about it, but they still had basically no debt. They still had billions and billions of dollars sitting on their balance sheet. They still completely dominate the social media market. They're still the same main company that people are using for advertising. So you sit there and go, well, hang on, there's something off here, right? So I started buying Meta back in like the 180s, and it's at like 450, 460 or something at the moment.
Yeah.
So it's just unique opportunities that present themselves to add to the portfolio, as opposed to suddenly deciding, or this thing that I own, I suddenly want to double down on it. So it's more a case of a unique new position rather than randomly getting massively aggressive on something you already own, if that makes sense.
Makes sense. Okay, good. Macro.
Mm-hmm.
Diving into current thoughts. Obviously, we've got an election year.
Yep.
We're starting to see slowly, I guess, maybe a Fed pivot on the horizon.
Mm-hmm.
What are your thoughts in macro? How do you kind of see? Are you bullish S&P? Are you bullish markets? Are you bullish risk?
So at the moment, I am still predominantly long US equities. GDP is still printing positive over in the US. There is obviously the obvious underlying risk in that all the time interest rates stay higher and stuff like that. It is obviously deliberately being done to squeeze the economy, to obviously slow down inflation, right? So they are deliberately trying to slow the economy down. It's the easy way of thinking about it. Because of that, the risk there is more a case of how long do they remain at slightly higher rates than what we've been used to over the last sort of 12 to 14 years. I don't think we're necessarily going to go back to a zero rate environment or virtually zero rate environment, because that's also not normal. We've kind of got used to it and got comfy since the GFC in 2008, but that's not a normal environment either. So my personal view is there are some risks at the moment, but the economy is still doing well. So all the time that is the case, you're going to be predominantly long. Because if you look at the relationship between, say, the US economy and the US stock market, they do exactly the same thing 70% of the time. So quarter on quarter, year over year, 70% of the time they move in exactly the same way. GDP's up, S&P 500's up. 25% of the time you have it where GDP goes up and the S&P will go down. It's normally a time when markets are overvalued and stuff like that. And only 5% of the time does it ever happen where GDP falls and the S&P goes up. That's data going back to 1950, over the last 74 years, right? So when you look at it like that, you go, well, GDP is still growing. Why would I be short? Doesn't make any sense not to be, because unless you think we're in a massively extended market and a massively overvalued market where you could have a scenario where the market falls where GDP still rises. But even if your view is just to do the same thing, well, you're going to be right 70% of the time. If you can then identify or get pretty good at identifying when markets are overvalued, well, now you can start getting it right on that other 25%, if that makes sense. You're never going to be right 95% of the time. You're never going to get it right all the time.
Yeah.
But the point is, if you go in line with the general economic expansion contraction, your direction is going to be right most of the time. So although I think there are underlying risks, there are still signs of some positives. Consumer sentiment, for example, has been rising, has been nice and bullish recently, stuff like that. So when we look at it, you go, oh, the economy is still growing. I'm not going to bet against the economy that is showing me in the data it's growing. Year over year, GDP is still growing. Quarter over quarter, it's still growing. Unless that starts to shift, unless we start to see a big slowdown, anyone can do this easily. If you look at Google, if you look at GDP year over year, annualized GDP year over year percentage changes, you'll tend to find before we go into contraction, the year over year figures start to slow down as well. Although they'll still be positive, they'll start to slow down. At the moment, we've had it actually accelerating to the upside. So that's the opposite of what you normally see before a recessionary environment.
Yeah.
So there are risks, but I'm not going to kind of force my view on the market. The market's still bullish. The economy is still bullish. I'm going to remain predominantly bullish.
Yeah.
If I start to see the data actually shift, well, then I'll start to shift. And obviously, if the market starts to give me signs as well. You also look at other asset classes. bonds aren't really bullish yet. Commodities aren't really doing much or anything like that. So we're not seeing a rotation out of stocks into anything else either. So there isn't really a reason for me to rotate my portfolio either. If I start to see signs of the economy slowing down, if the stock market starts to contract and starts to fall, if we then start to see money rotate into bonds, well, then the signs will be there and you can adjust your portfolio accordingly. But
Yeah.
at the moment, I don't really see a reason to, basically.
And if you started seeing warning signs, you mentioned you wouldn't take a cash position. What would you do? Long bonds?
So yeah, potentially rotate into bonds,
Long
depending.
bonds, buy diamonds, I think is a famous saying.
Yeah, buy fine wines.
Yeah.
And all that. No, it's predominantly be a case of, obviously depends what the market wants to do, right? So if you normally look at it, you can basically split the economy up into 4 different quadrants. It's a bit of a Ray Dalio thing, but different economic conditions. So economic expansion, economic contraction, inflationary, deflationary, right? Depending on the environment that you're in will depend on different asset classes' performance. If you go into an environment that isn't inflationary but is slower growth, you tend to find bonds do best. So if we was to imagine, well, inflation kept coming down, but then the economy slowed down, theoretically, that's the environment we rotate into, right? So on paper, bonds should now do the best. So if you start to see that environment present itself, and you also start to see a continuation of stocks then starting to fall and bonds clearly start rotating, yields start to fall, stuff like that, well, then the market is telling you that's what's going on. So now follow the money kind of thing.
Yeah.
I would still obviously have stock exposure, but I would just now trim back that exposure, because even in a bear market, there's some stocks that will go up. It's not like everything goes down.
Yeah.
So obviously you've got to sit there and work out, where do I want my money to be? What sectors are going to perform best? You look at 2022, for example, energy sector was up like 60 odd %, despite the fact everything else was down massively.
Yeah.
So there's always going to be opportunity still there, but the opportunity set's going to be smaller, and you've now got a new opportunity set over here. So I would quite happily hold some duration, hold some bonds, stuff like that, and kind of rotate into there if necessary. It's all really going to depend on how markets shape up. I'm going to listen to what the market's telling me, basically, and where the money is rotating.
Yeah, makes sense. And how does a Fed pivot kind of fall into your view? Because you've got the camp that say, when the Fed pivot comes, that's normally when things start to sell off. Some people are saying actually it's going to accelerate things this time because this time's different. Where do you what camp do you stand in?
I try not to make forecasts and predictions too much.
Yeah.
If you're going to look at probabilities, historical data will tell us that generally when interest rates start to fall is when the economy we then go into that recessionary environment. And the general reason for that is because they hold rates at a position until their desired effect has taken place. That normally means something breaks within the economy, and that's when you get that economic contraction. They're like, okay, now we need to reduce rates.
Yeah.
So that's why that cycle tends to happen, because they like you said, they raise rates, deliberately slow the economy down. They're trying to stop everything. And then normally by the time that desired effect's taken place, any monetary policy and any kind of decisions the Fed make, it takes time to filter through to the economy. So even if they decided today to start cutting rates, the effects of having the higher rates over the last few months, a few quarters, is still going to be filtering through in the economy anyway.
Yeah.
So normally by the time they've seen the result they want to and start to change their policies, the effects are still taking place, and that's why we then generally have that slowdown within the economy. But I'm not going to try and predict that. I'm going to sit there and say, well, let's see what actually happens, because, again, I want to follow the flow. I'm not going to sit there and try and be the hero and try and call the market top or call the market bottom or whatever. I'm going to sit there and say, well, see what actually does happen, see what the Fed do actually do, rather than trying to predict when they'll do it, see what the economy is actually then doing at that time, and see what the market is actually doing at that time. But there's no way of me knowing, so why am I going to try and predict it too much?
Yeah.
You don't need to massively be ahead of the curve to make money. You're actually more likely to lose money by trying to predict things and be ahead of the time, because most of the time you're going to be wrong, because the Fed could change their stance on things, and inflation could massively spike again, or it could really fall really quickly over the next few months, more than expected, and now the Fed start cutting before it affects the economy. All sorts of things could happen that we don't know.
Yeah.
So I think don't try and predict it too much. Just kind of see what happens, see what the Fed do, and then from there you can kind of gauge it. But I don't think you need to be ahead of the curve too much, in my opinion.
Makes sense. A real trader's answer. You don't want to be right. You want to make money, right?
Exactly. I want to make money, so
Yeah.
I don't care about being the first person to say the market's topped. I just want to make money one way or the other. So at the end of the day, I'm going to let things progress and see how they play out.
So in terms of differences in the market since COVID, have you seen any differences? Anything that you notice in particular, or?
I don't think there's any real differences as such. I think maybe there's more money coming in, more money flowing in terms of people that weren't necessarily involved in the markets before that have been. But I think that always tends to happen when you have periods of big bullish markets. Everyone wants to be involved. You probably see it in crypto, right? All of a sudden, everyone's probably asking you now about Bitcoin that wasn't asking you 6 months ago, right?
Yeah.
So it's the same thing with stocks. It's the same thing in any market. All of a sudden, because something's gone up, now all of a sudden everyone wants to talk about it. Now your barber's suddenly asking you about it, and you go out and everyone's talking about it in a restaurant or whatever.
Yeah.
So I think because we've had such a good run over the last 3.5, 4 years, that a lot more people are involved, generally speaking. At some point, the market will shake those people out because markets will fall. And despite that being the best time to actually buy, like we were just talking about buying a Vanguard index, for example, and stuff like that.
Yeah.
If you're dollar cost averaging into something, the same way you could do with a stock if you really like the business, say you was a big fan of Microsoft and you thought they was going to continue being the best company in the world for the next 10 years, just constantly keep buying to the stock all the time. The best time to be buying it is when it's falling because then you're buying at a better price.
Yeah.
Same thing with a general index or whatever. If you keep buying it all the time consistently, you're always getting the best price over the long term. So that is normally the best way of doing it. Whereas what most people will do is when markets eventually fall, that's when they'll panic and get out and they'll get in when it's gone up. There was a Fidelity fund that, so Peter Lynch had one of the best track records throughout predominantly most of the 80s, basically, right? He averaged like nearly 30% a year just buying stocks. One of the best track records in Wall Street history over like 13 years. Yet the average investor in Fidelity over that time lost money. And because what most people are doing is markets are going up, everyone gets excited, starts investing. Markets come down, they all start to get scared, they pull out. Markets go up, they start investing. So they're literally buying the top, selling the bottom, buying the top, selling the bottom. So they're doing the complete opposite. You've either got to be consistently investing and then be more aggressive when things drop. So COVID would have been a good example of that, right? Be more aggressive, or just do the same thing every month or every year or every quarter, whatever your preference is, right? Just keep buying. Just keep buying.
Yeah.
Because things go up over the long term. So if you're buying individual companies, just buy the best businesses on the planet and just keep holding them. And if you're in the overall index, just keep buying the index, right?
Yeah.
And you just own everything by default anyway. But by doing that, you're just constantly in the game. And now you don't need to predict necessarily where everything's going. The only time where it really makes a difference is if you're trying to, like, I look for a risk-adjusted performance. I'm not necessarily trying to outperform the S&P. I'm trying to create a smoother equity curve. So obviously, in the ideal world, I'd like to outperform the S&P, but I know the reality is you're not always going to do that. So I'm looking for a smoother equity curve because I don't want to have a 50% drawdown.
Yeah.
Every single asset class in history, whether it be bonds, commodities, crypto, stocks, whatever, has had a 50% or more drawdown at some point. It's just the nature of markets, property, everything does it at some point or another, right? So if you're invested only in one asset class and you're always long that asset class, at some point you're going to have a big drawdown. Just the nature of investing. So for me, I don't want to have that big drawdown. So I'm looking to actively manage to reduce my drawdown. Now that will mean sometimes because I offset some of my risk, diversify, hedge, things like that, I then don't always capture the same upside. But I'm looking for that risk adjusted return and trying to smooth the equity curve rather than just absolute return, if that makes sense.
That does make sense. Yeah. One of the sectors that we saw, was an outlier in post-COVID era was tech. Obviously, the ARK ETFs went mental. Now we're seeing AI kind of really blow up. Nvidia gone crazy. Do you have any exposure to AI or any thoughts? Is it a bubble? Are we still going to see liquidity flow there?
I think it's hard to define a bubble, right? Because I think people just look at a bubble as something that's gone up a lot, but a bubble really would be something that's massively rallied that doesn't actually have that true value and eventually collapses on itself. The argument for AI is that it is going to be a massive driver over the next 5, 10, 20 years because obviously that technological advancement. Now, whether an individual company like Nvidia, for example, is a bit of a bubble, then because obviously it's gone so parabolic, well, obviously that's a bit of a separate thing because naturally you're going to get mean reversion. All assets mean revert. Nothing goes up in a straight line. If you're always going to get this, so you always get that mean reversion. Sometimes you're overvalued, sometimes you're overvalued, but you get this kind of effect. Same as if you put up a chart of the S&P 500. Since the start of time, it's always done this. So there's going to naturally be a correction at some point. But obviously, Nvidia is in a very, very good position for that AI boom. They're like the picks and shovels plays, right?
Yeah.
They're not developing AI themselves, but all the GPUs and stuff like that, and the tech behind being able to offer, these companies that will offer AI services, they're providing that. The thing you have to be careful with in tech is a lot of the big players have a lot of money. So we've seen it time and time again with all sorts of different things over time. Like Apple's done it numerous times, right? The different components for their phone, they might have used a certain company, then eventually gone, now we're just going to build that on our own. Like the chips, for example, the M1 chips, M2 chips, M3 chips, I think they've got now, right?
Yeah.
They used to use Intel, I think it was. For years, they were using Intel for their chips. And then all of a sudden, just one day went, yeah, we're just going to build our own ones. Because they've got billions and billions to play with. They just set up their own team, build it internally, and off they go. You can't now compete with that. And I think that's what's very different with tech nowadays. Like you look at the big company leaders, say 100 years ago, right, which would have been your railway company, stuff like that. They didn't have a grip on society in the way that tech companies do now. All of us in this room have probably got an iPhone or if not a Samsung, right, like an Android.
Yeah.
So odds are you're probably going to stick with that device in terms of that ecosystem, because the amount of a ball ache it is to move from going from an Apple device or like a Google device or whatever and shifting across, your whole life becomes on there. You're in that ecosystem. So you're almost trapped, for lack of a better word, within as being a customer of theirs. But they've also just got so much money. Like I've got a friend of mine who worked at Google for a number of years. And he said that they will literally do things such as, let's say there's a new up and coming company that they think might be a bit of a threat to their one of their divisions. They will literally buy that company for say $50-60 million and just shut it. Because they've got so much money to burn, they can just buy it for 50 million quid and just close it down.
Yeah.
Because they can just get rid of competition like that. And also, even if they have somebody that won't sell to them, they've got so much money and power and influence in that market that they can make it very difficult for that company and probably just overpower them anyway. So those sorts of players in the market are probably always going to be the main players. And AI could now be a new shift and another way where a lot of these big companies, such as Microsoft, Google, and that just get more and more of a grip, basically, of our day-to-day life, because they're probably going to be the main players in that space again. But NVIDIA and people like that obviously going to have their role of building the components. The risk is, do other companies start to eventually build those parts and then start to take some of NVIDIA's market share? That's the kind of the worry, if you will, as an NVIDIA investor, if you was an NVIDIA investor.
Yeah, it's interesting to see, and it felt, especially in crypto, which we'll dive into in a second, a lot of the crypto market, it felt like, was waiting for NVIDIA earnings the other day. And then when they came out good, then everybody was like, okay, Max Long. It's back
it seems to correlate, right, with tech a lot.
Yeah. Well, I mean, interestingly, Brent Donnelly put out a piece the other day that showed Bitcoin and the TQQQ, which is triple leverage NASDAQ, they're literally
identical.
Yeah, they're identical. Yeah. Since 2019, they are
basically juiced up tech, essentially, is what it is. Yeah,
effectively, yes. It's the way I see it is it's a leverage bet. It's like a beta NASDAQ play. If the NASDAQ does well, Bitcoin's probably going to outperform. On the downside,
it's also going to draw down more.
Yeah, exactly. But it's literally the same as the TQQ, which is why, coming back to this year, I'm pretty bullish. I'm long US equities like you, but I'm extra bullish on Bitcoin, and then I've got kind of exposure to crypto stocks as well, like Coinbase, a few Bitcoin miners, and things like that. How do you view crypto? Because we nearly made an all-time high yesterday on Bitcoin, but we just missed it by $400.
Probably will very, very soon.
Yeah, probably will soon. Do you think it's overheated? Do you think that correlation with the NASDAQ will continue? And if the NASDAQ has a good year, Bitcoin can actually continue and maybe get to 100K? Or
I mean, my thing with crypto, I don't personally hold crypto. I've got nothing against somebody having crypto. I think the only time I ever sit there and kind of question it or kind of frown upon it, if you will, is if someone's just like 100% long crypto and that's the only type of investing they do. Because like you said, it's very volatile. Like, it's almost like a leverage bet, right?
Yeah.
The thing is with crypto is, despite the fact it's been around for a good 15 years or whatever now, right? It is still very much in its infancy, and we don't actually have a true place for it set in stone anyway, in terms of, its day-to-day usage or whatever. And even if something is used, let's just imagine it's Bitcoin. Imagine Bitcoin becomes a main currency that you can use on a daily basis to go and get your shopping. That still doesn't mean it should be 100,000 a coin or 10,000 a coin or 50,000 or whatever. That valuation aspect doesn't just depend purely on usage, the same as normal fiat currencies, right? The pound, theoretically, is more valuable than the dollar in terms of it takes more dollars to buy a pound, whereas the USD is the main world reserve currency and used for most transactions. But yet the pound, in theory, is stronger, right, than the dollar is. So just because it's used more doesn't make it more valuable. It's the same thing with Bitcoin. Just because it gets used day to day doesn't suddenly mean it'd be worth more in the future. So I look at it very much as speculation. Um, and there's nothing wrong with that. The same as sometimes you'll have stocks in your portfolio that aren't really doing much at the moment in terms of the company, but you've got a big view on them over the next 5, 10 years. And it's a bit of a speculative play, but if you're right, you'll make a lot of money.
Yeah.
You've just got to kind of find your sweet spot with it and have an amount of capital, portion of your net worth, whatever you want to call it, wrapped up in crypto in a way that is sensible relative to the risk that you're prepared to have.
Yeah.
In the same way that if you're not comfortable being 100% long stocks, you diversify into bonds or commodities.
Yeah.
It's the same sort of thing. You'd have a portion of your portfolio in crypto that you're comfortable with, and if it dived 50% tomorrow, it doesn't make any difference. Do you know what I mean?
Yeah.
But you also sit there going, I want to have that exposure because it might also triple over the next year.
Yeah.
So just have a level of exposure that you're comfortable with. I don't personally hold any, but I've got no issue with somebody having it if they do it sensibly. It's the same as any investment, really.
Yeah. It's a similar kind of thing. Anyone who gets into crypto kind of gives similar advice. Only put in what you're willing to lose. You could put in 5% and it becomes 50% of your portfolio, but it could also go to 0. If it's 5%, it's not going to make a massive, it's not going to kill you,
No, exactly that.
But cool. So tell us a bit more about what you do now. You mentioned you run some floors, you do some training. If people like what you say, they want to learn from you, how can people kind of find you? Or
Best place to find me on social media is normally Twitter. I'm going to start making more of a point to post again on Instagram. I kind of just got bored because obviously there's a lot more to it, right? If I get an idea in my head, I could just post something on Twitter in 30 seconds. I don't have to put a production up almost and film myself. But I'm going to start trying to make more of a point of posting on Instagram. So you can kind of find me on either or. I've then got like a newsletter that I run. So it comes through, stock market analysis, macroeconomic data, all sorts of bits and pieces. There's a free version of that. It's just called QV Capital. So if anyone wants to find that, that's on Substack. I'm also going to start providing some education as well. I've just partnered up with ASFX, Austin Silver at ASFX. We're releasing a portfolio management course soon. I don't know when this recording is going to come out, but it may or may not be before or after we launch that later this month. So there's going to be a few different ways and bits and pieces and stuff like that. It already depends on what the person's looking for. If they just want some research and some tools and bits and pieces, then get the free version of the newsletter and that could be sufficient for you. If you want to kind of learn my processes and stuff like that, then obviously get in touch with regards to kind of education. It all just depends on what the person wants. I'm not going to try and sell anybody on anything. It depends on what they need, basically.
Yeah. Okay, cool. And last question: if you weren't a trader, what would you be? What would you do?
What I like to do.
Yeah.
What I like to do is go and play golf. I play a lot of golf now, but when I was like 16, I had a sponsorship and that, and I was playing semi-professional, I guess you could say, playing on like a tour around the UK and Ireland and that. But kind of fell out of love with it, being in hotels all the time when you're like 17 and your mates are starting to go out and stuff like that. But yeah, I'd probably go somewhere down that route, or something sport related, because it would be something I'd actually enjoy.
Yeah.
But yeah, probably quite hard to say, to be honest with you. Probably broke because I wouldn't be going and working in a normal office. I can't do that kind of stuff. It does my head in a lot of the stuff like in normal 9-to-5 jobs. I couldn't do a 9-to-5 job anyway. Put it that way. I couldn't bring myself to do it.
It's hard working from home sometimes though, because you want interaction with people, right?
Yeah, there is also that. Yeah, sometimes I'm kind of sitting there in the middle of the day. You're having lunch indoors and you're like, it's dead quiet. It's just me, myself, and I. Like the missus is at work. I'm just sitting here indoors on my own. And like you say, unless you've kind of got meetings that day on Zoom or you're out and about or whatever. But then there's the other side of it where I quite like it, because then sometimes you sit there and you think, it'd be quite good to have the social element. And then you might be in a social environment. You think, I wish I was at home on my own.
Yeah, literally.
But yeah, that would probably be. I'll probably do something that wouldn't be a standard 9-to-5.
Yeah. Also, getting the train today as well is a bit of a nightmare. It reminds you, doesn't it?
Yeah, exactly that. I wouldn't be able to get a train into London all the time. And today has reminded me why I don't live in London anymore.
Makes sense. Any other gems you think you can final words share with the people?
Look, I think the biggest thing, if you're getting into markets, just take your time with it. I think so many people are trying to cut corners. Either they hate their day job or whatever it is, and they're just trying to look for an out. Trading isn't going to be that thing that magically solves your life. It's not going to solve all your financial problems. It's not going to get you out of debt or whatever. So if you're going to do it properly. Invest sort of money in the education, but also the time. Be willing to put some work and effort into it. It's not a shortcut, but if you're willing to do that, of course, there could be some rewards, but it will take time to get there. You're not just going to suddenly flip it overnight. So just be prepared to put time in. And as long as you do that, take your time with it, you'll probably be fine.
Makes sense. Brilliant. Thanks for coming on.
Thanks for having me, mate.
Appreciate it. Cheers.